What if I told you that one decision, just one, could change the entire trajectory of your financial future? Not a new career, not a windfall, not a market timing miracle. One rental property structured correctly. I know that might sound like a big claim, but today I want to walk you through exactly what the numbers look like when a single rental property is connected to the right mortgage strategy and show you why this is one of the most powerful wealth building moves available to everyday Canadian homeowners. So let's get into it. First, let's talk about why most landlords are leaving money on the table. Owning a rental property is a great start, but most landlords are running their rental the expensive way without even realizing it. When the rent comes in, the expenses go out. Maybe there's a small surplus, maybe there's a shortfall, and they're probably covering it with their own funds out of pocket. And the primary residence mortgage just keeps ticking along at its normal pace. Unconnected, unaffected, not benefiting at all from the fact that there's a rental property in the picture. That's the default. And that default is costing people significantly over time. Because when you introduce a cash flow dam, connecting your rental income to your primary residence mortgage before it even touches rental expenses, that rental property stops being a standalone asset and becomes an engine that drives everything forward at once. Your wealth building, your mortgage paydown, your tax efficiencies, all accelerating simultaneously. So let's run some numbers. Say you own a primary residence with $400,000 remaining on the mortgage. A standard 25-year amortization, regular monthly payments, nothing extra is happening. No rental property in the picture yet. At that pace, just making your regular payments, your mortgage is going to be paid off in 25 years. You've paid a significant amount of interest along the way, and you've arrived at the finish line with your home equity and whatever else managed to build separately. Now that's path one. It's fine. It's really what most Canadians do. Now, let's add the rental property. So say you purchased a rental property, a condo. It generates $2,200 a month in rental income. Your rental expenses include the mortgage on the rental property tax, condo fees, insurance, maintenance. It might run you about $1,700 a month. So you're cash flowing $500 a month in positive cash flow. Without a strategy, that $500 surplus maybe gets saved, but it might also get spent. Now, yes, the rental runs itself and the primary mortgage runs itself. The two things exist in parallel, but never talk to each other. With a cash flow dam, everything changes. That full $2,200 in rental income hits your primary mortgage as a prepayment every single month, and that's on top of your regular mortgage payment. Then your HELOC covers the $1,700 in rental expenses with interest that may be tax deductible because the borrowed funds are tied to an income-producing asset. And your $500 surplus, that gets invested. Now look at that difference. The same mortgage, the same primary residence. The only thing that changed is how the rental income flows before it covers the rental expenses. The rental property just took years off of your mortgage, and it did it without changing a single thing about your monthly budget. But here is where it gets even more interesting. That's just the mortgage acceleration piece. Let's talk about what else is happening at the same time. The $500 monthly surplus, the positive cash flow from the rental after the expenses, is being invested every month, not just sitting in a checking account, not getting absorbed into day-to-day spending. It's invested. And over 20 years, $500 a month of invested funds at a conservative average return builds into something significant. That right there is your retirement income. Or maybe you can use it as your child's education. That's financial flexibility you didn't have before. And it's coming from a property you already own, just structured correctly. Now let's look at the full picture. On side one, a primary mortgage that's being paid down years faster than it would have been, saving tens of thousands of dollars in interest along the way. On the other side, a growing investment portfolio funded by rental surplus, building equity month after month, compounding over time. And sitting underneath all of it, a rental property that's appreciating in value, building its own equity, and generating income that the CRA is partly subsidizing through that tax deductibility of the HELOC interest. That is what one rental property can do. Not when you get lucky with the market, not when you buy into the perfect neighborhood at the perfect time, just when it's structured intentionally. Now let's be very clear about something. This is not a get-rich-quick pitch. This isn't a promise. Real estate carries real risk. Interest rates move. Vacancies happen, maintenance costs surprise you, and the cash flow dam has to be set up correctly. With the right mortgage product on your primary residence, clean account separation, proper CRA documentation, and professional guidance from someone who understands both the mortgage structure and the tax implications. But for a Canadian homeowner who has the equity to purchase a rental property, the primary mortgage in place, and the discipline to run this structure consistently, the long-term picture is genuinely compelling. The rental isn't just an investment, it's a lever. And when you pull it properly, it moves everything. Here's what I want you to take from this. Most Canadians think about a rental property as a separate financial decision, something that either cash flows or it doesn't, something you manage in isolation from everything else. What I want you to see today is that rental property connected to the right primary mortgage strategy is one of the most powerful wealth building tools available to everyday Canadian homeowners. It can pay down your mortgage faster, it can fund your retirement, it can build your children's education, it can create financial breathing room that most people spend their whole lives chasing. And it doesn't require a perfect market, a massive down payment, or a complicated portfolio. It requires structure, and structure is exactly what I do. If you want to understand what this could look like for your specific situation, your mortgage, your equity, your numbers, book a call using the link below and let's chat. And if you found this valuable, share it with someone who's been sitting on the fence about a rental property, because sometimes all it takes is seeing the full picture. And stick around. There's a lot more to come about how to make your mortgage work smarter so you don't have to work harder. Mortgage Free with Erica V.